Okay, so that's.
Is someone online?
Somebody's.
Mhm.
Somebody says she's copied.
Who is that?
Kim.
Yeah, the one.
No, I think she has a unit, doesn't she?
I'm gonna say, I think she's reimbursed.
Green color, bar, mute.
Steve, the professional.
Do you want me to text Kim and tell Kim to mute her thing?
So you can't see it from back here. It's too far away. Yeah, I wanted to go back to that, but I need to be able to see this at the same time. Because this keeps out, so I have to keep hitting the button. That's what it did to Kathy the other day.
Let's do it. Give me a hammer off.
Um, August is Sunday. I don't know.
Oh, go ahead and then add people. Go to add people.
I was thinking I read this on the 20th.
So then, so you're gonna do that, you know, again. Yes, ma'am.
I sent her a text saying mute or something.
Here, I got it.
Okay, we're just gonna-
Okay, Steve, now what were you gonna do?
So you want to just share your screen so they can see your PowerPoint?
But I still need to be able to see what I'm doing too.
You just share a tab. Go to window at the top. Yeah. There you go. Now you should be able to see those. I don't know if you'll be able to click through. That's the tricky part. You still have to click through the presentation. So now if you minimize that, you may still see that presentation,
Minimize.
the PowerPoint. Yeah, so they're still gonna see that PowerPoint, but
Okay, so then go back to here.
Yeah.
For us.
yeah, so but you'll still have to, yeah, there you go.
You do good.
Okay, is that where we're
You
at?
need two monitors.
I'm sorry.
No,
I need
you're
a lot of, I need a lot of things.
Okay. Page 5 is next. So now on page 5, I'm moving from 2025 Senate Bill 1 to what was approved in 2026 this year. So House Bill 1210, that structure we just talked about on local income tax, it moved from 2028 implementation to 2029. So they push it back 1 year. So the county will have to adopt the rates in 2028 to be effective in 2029, the county council. The first adoption, the way it reads in the statute, shows a 3-year adoption. And then after 2031, it's readopted every year after that. So the first year you adopt in 2029, last through 2031, and then readopt every year thereafter. Now, instead of the 3,500 population number, now all cities and towns can opt in to the under 3,500 rate, which the county sets. And like I mentioned before, that is what we have found. That's much more beneficial to those cities, the most cities and towns in the state, to opt into that rate compared to doing their own. So I did have a question. Has anybody reached out to you guys, like Syracuse, Warsaw?
Not in any official,
Okay.
capacity, but the state law does say that we need
Yes.
to do the committee.
Well, it's not required, and it does have language in there that says if you make a decision, it must be unanimous. I don't think you have to make it. Suzanne may have a different, but what I read is you don't have to make a decision. If
Right.
you do, it has to be unanimous.
It's, yeah.
Yes, yeah. So I'm sure they will be reaching out to the county because, you know, they benefit more from the county setting the rate than doing their own. The ones that are over 3,500 population. So
Church Golf sent a email to me yesterday from Belford asking about the must committee
yes,
to see if anything had been done. And I just sent one back and said, nothing's been done yet, but we know it's on the horizon.
yeah. They call it the
No.
MUST Task Force. Is what it's called. So it's one member from county council and then a fiscal officer for each one of those cities, towns is what it'll be. So I will help you guys on the numbers. You may have them already, but I can help you out with that on the formula as well.
So just to clarify, I'm sorry. And then
No, that's okay.
I'm
No,
asking better
you keep
questions.
asking now.
Seated and edit, we would be able to continue to collect that until such time as we switch, and then seated and edit goes away.
That goes through 2028.
Okay, but then it goes away.
Then it
And
goes
has
away.
to be a part of your bigger structure.
Yeah, so I didn't mention that earlier and I apologize. So local income tax, the current structure is you're seated, or Coet County.
What, yeah.
Coet County. So everybody has votes, right? When you set an income tax rate, everybody in the county,
No, the county controls it.
the county controls it from your side. Okay, the county controls it. So when you set an income tax rate, then it's distributed by an allocation formula based off previous property tax and income tax distributions. So that's how it's currently set. This new one, like we discussed, the county will set the rate, and then for this, for the county rate, the county gets all of those dollars, and then the city and town rate that we were just talking about, that will be distributed by population. So that's the formula that we can help you out with once we get there. We talked about the task force. I did do the formula. I show about the county would receive about 28% of that rate, whatever they set that rate at, 28% of the dollars. That would be on top of the county rate that you said. And then finally, they capped fire districts' property tax rate at 40 cents. They did fire territories last year at 40 cents. Now fire districts are capped at 40 cents. Any other questions on House Bill 1210?
Well, it says this municipal unit strategic task force may be established. That's what you were saying?
Maybe, yeah, I
Okay.
put the word maybe in there because it's not required.
But if you don't, doesn't the state come in and tell you what to do? I think that's the next paragraph after that.
I mean, we're recommending not to agree to anything because you don't know what legislation is going to do next year on tax rates. Like they do say if you agree by October 1st, that will be the rate. But as you know, they've been thinking about reducing the county's cap. Right now, the county's cap is 1.2%. They come in next year and say 0.7%, then how does that affect what the task force did, right?
Well, especially if the
It's-
new rates aren't even gonna be coming into effect and we're meeting before in
Way
this
out.
year when we
Yeah.
won't even be.
Yeah.
Our new rates won't take effect until 2029.
Correct.
Seems kind of like.
It's just another one of those
Yeah,
things.
you wouldn't start the committee. What'd you say?
It's just another one of those things.
Sounds to me like you wouldn't want to start the committee till after next session.
Yeah.
Yeah,
Too.
yeah, I agree.
Get closer to that.
I think it's early,
Yeah.
but they did put an October 1st, 2026 deadline on it.
To form the committee or to make a
To
decision?
form and make decisions, if you make a decision.
Doesn't mean you can't form the committee and meet and not
Right.
make decisions.
Yeah.
Right, you can
Yeah.
discuss it. Yeah.
Goodness, the advantage that you could go down and testify to as a committee and talk to them about how your county looks. If you
Yeah.
do form the committee this year.
And I would say, not everybody's represented by Reedy Financial Group or Baker Tilly's of the world. So they don't even know what their losses are gonna be yet with property tax, right? I would say some of them don't know. So how can you come to a conclusion on rates when you don't know all of the data? In my opinion. But yes, you can still get together and discuss. Page 6. Senate Bill 179. I'm sure Steve knows about this one. CC&G second call approved for an extra 75 million for the units that didn't get matches in late 2025 and fall 2025.
That's what we received already. So we got the award letter, right after the commissioners meeting last week. We went in, we were part of that extra 75 million. So that's what to extend out Packard and Armstrong.
So something new, wheel tax. So if Warsaw, for example, would now go in and do their own wheel tax, the county could no longer, when it takes effect, could no longer collect off the registered vehicles in that area. Now the counties that had stacked taxes before had a county and municipal wheel tax, those are grandfathered in. But if it takes effect after December 31st, 2026, then it's separate. Now I will say, I'm working with the county, it actually benefit them when municipality did their own wheel tax because they now have even higher proportion of the road mileage and population. But I don't think that's the case for everybody. I think it's a case by case thing. So just something to keep in mind if you hear about other municipalities wanting to do a wheel tax, it could impact your wheel tax revenues. Again, wheel taxes need to be submitted by September 1st to be effective January 1st of the next year.
It's ridiculous. Does that say? Oh. But that's what I would think. Yes, we're still there. Show my, what's his name? Show my screen. Okay.
May still need to, yeah, go to the presentation. The one, excuse me, the one to the right.
This one.
Yeah, they go to the right. There you go. Any questions on that?
It needs to not time out. We're gonna have to have a conversation with the IT.
That's all right. Page 8. I'm just getting into 2025 numbers now. So the county, everybody on page 8. Sure. The county grew cash by $7 million in 2025, mainly due to unused appropriations. So that's common for the county. Had quite a bit. Maybe there wasn't as much bridge projects as you originally thought. I can't remember on that.
Carry over our bridge.
Yeah, you carry over. And then there, I'll have another page that shows all the unused, but that was the main brunt of the $7 million in growth for all your funds. The general fund had a surplus, so revenues over expenses of $2.5 million. As you guys know, your cume bridge rate increased 0.0057 cents, which equates to about $622,000 in levy. So that amount in the cume bridge, whatever you increase or decrease that amount to, that pulls from the general fund and all your other property tax levy funds. So if you see that maybe you have enough cash for 2027 and you need to reduce a little bit, that pushes some to the general fund for operations. And then your net assessed value, like we talked about earlier, even with the slight increase in deduction, it still grew 8.23% in 2026. So you guys have strong growth right now. The more you can continue to have strong growth, the more you can offset some of the Senate Bill 1 impacts. And since 2022, your property tax rate has reduced 4.5 cents, just quite a bit. And I'll show that on another page as well. Page 9. This is just an overview of the major funds that I keep track of for the county. Oh, that's okay. You can see starting from the left, you have your funds, and then I have your beginning cash balance, expenses, revenues, if you surplus or deficit in that fund, and then ending cash balance. But the yellow column is what I wanted to show you on the unused. Now it was high, the unused was high in 25, but typically the county does have unused appropriations, which is a good thing for building cash. But I'll show you here in a second how that might change in the future. But as you can tell, there's just quite a bit of unused that led to a lot of savings in cash, which I think you'll need down the road.
But we also need to look at what was encumbered.
Yes,
That's gonna make.
that's
that
correct.
figure
So-
look a whole lot different.
so like your general fund, you encumber wages every year a lot. So that's going to increase your unused because they may have worked at the end of 2025, but you actually pay it in 27. I think that's why you encumber those amounts. So
all that gets deducted from the
yeah,
And the same thing for the bridge fund, like when we talk about like, and I gave you my projections for the next 5 years. These have to, because they're 5-year projects, you have to build up. We only get 800 and some thousand. Well, you all know a bridge doesn't cost that, right? Even the 20%, well over that. So what we have to do is bank that money, build it up so that when these projects do hit, that we can afford those. But still, that's what, the projection that I gave Reedy here, I don't know, a couple months ago, it shows you in 2027, you were getting pretty tight.
yeah. So, and I keep track of that. He gives me his projections. I keep track of that in the financial plan. You'll see that in all these other tabs in this binder, but I keep track of that just to try to make sure you have enough money in the King Bridge Fund to pay those local matches. So, any questions on 2025? So this is one of my favorite slides, page 10. So the top purple line is your net assessed value, and the black line and bars at the bottom is your property tax rate. So as I was saying earlier, your net assessed value growth has always been higher than the growth quotient that the state, not always, since 2022 on this graph, has been higher than the growth quotient that the state sets every year. So your net assessed value is growing higher than revenue growth, your tax rate's going to go down. And then you can see your tax rate since 2022 is, like I said, down 4.5%. Now, I expect as we get further along in the Senate Bill 1, that those two lines will get closer together. They'll flat line on both sides and maybe even start creeping toward each other. So, but if you continue strong growth, you delay that. And then 2025's property tax rate, I compared 19 other counties to you guys based on net assessed value. You're the 19th lowest. That's pretty good. And that data is in this binder too. I can show you later if you want to find it. Any questions? Okay, cash reserves in your general fund only. So on on this graph, I have the year 2022 through 2028. And the blue line, the blue bars are your revenues, the red are your expenditures, and then that purple line at the top is cash, year-end cash balance. As you can tell, 2022 through 2025, the blue line's higher than the red. But then I've built in Senate Bill 1 impacts starting in 26, 27, and 28. You can see how the red line starts to creep closer to the blue line, and then your cash balance flattens out. So that's what we're going to see. I have a base like 5% assumed growth in your assessed value. If you keep growing at 9%, that purple line is going to be a little bit higher, right? Depending on how much you spend, but it just depends on how assessed values come in the future. But nothing to be alarmed because you guys are prepared for it. But just know that when you're making future budgets, that the reason that blue line gets closer to the red line is because circuit breaker is going to increase.
Because what?
Circuit breaker. So circuit breaker is the amount of your property tax bill that goes over the cap.
Mhm.
So if you have a $100,000 home, the max you're going to pay on that is 1%, it's $1,000. But if your tax bill equals $1,200, that $200 is circuit breaker. It's not collected. It's not collected. So the reason circuit breaker is going to go up is because those increased deductions that we talked about increases your tax rates, and therefore properties get closer to the caps because of that. And then also the homestead credit, which I call circuit breaker 2.0. It's not really circuit breaker, but I call it circuit breaker 2.0 because it's a pot of money that you're not collecting on
So-
top of the tax caps.
So basically what you're saying, as we get closer to 2028, our circuit breaker losses are going to be greater,
Correct.
which is why those are coming together.
Correct. That's the main reason. So tax caps because of deductions in your homestead credit. Yeah. Now, like I said, if you grow above what we have projected here, it's not going to be as significant. And then also, one thing, they cap the growth quotient. So the state sets a percentage that the county or that all units can grow their revenues by each year. And it's been capped at 4% the past few years. They didn't cap it for next year. So what I saw in the statutes, they were estimating it, they said 6%. So that could increase circuit breaker even more. I mean, it's kind of a blend of increasing your revenue. We're getting in the weeds here, but that could increase your circuit breaker, but also increase your revenue slightly. It just depends on assessed values.
When you did expenditures, did you figure in like inflation and wage increases?
Yeah. So I have 2% on wage increases built into this. And then other things I have like 1% a year. I know some years it's a lot more, and some it's tricky because there's a lot of lines in there. But like capital and supplies, I have 1%, but I know there's a lot of like contracts in those lines as well that stay flat every year. So I have a 2% on wages and like 1% on capital. And then there's some capital like what Steve gives me that I have built into the plan. So it's not a percentage growth, it's based off what he gave me. So yes, I have increases baked in there. All clear? So this is just an overview of what I have projected for 2026. I'm conservative, so I project unused appropriations for you guys because we have it every year. And I'm conservative, so you'll see some deficits in there that may actually be surpluses by the end of the year. But this is what I have projected in the financial plan. I think in August last year, I met with you guys. I talked about your highway funds, wheel tax, Q Bridge, you increased your rate. So, but those funds, gas tax revenues and wheel tax revenues tend to stay flat. They don't grow like property tax revenue and lit has. So you may start to see those, but your expenses versus your revenues in those funds get a little tighter. But you guys can more than offset that with income tax starting in 29 with the new structure. We'll see if they do anything different next year. So I did present a couple options last year, like will tax and things like that, but definitely with the new local income tax structure, you could make that for some of these deficit spends in these funds. Because it's one thing I didn't mention also, the new lit, it's general purpose, so you can use it where you want. It's not like current lit where it's public safety or economic development or judicial, et cetera. It's general purpose, so you can plug it wherever you'd like. I don't know if the SBOA will like that. We'll see. So this is just all projections 2026 that I have so far. Next page. Quick capital discussion. This is, as I mentioned, you were asking about expenses. This is the capital I had baked into the financial plan. So you can see highway department is all the red here. And then I have commissioners and sheriff department. I know you probably have a lot more than this, which is why I need to probably get with Alyssa for you to reach out. Usually I reach out straight to Steve, but other departments, if you have any big capital items coming up, let me know and I can plug it into the financial plan so that when you do your budget, I can see where we need to put that. Right now, if your edit fund is a good resource for capital, which I think the commissioners are using, but you have like $15 million in there. So just good for capital use. But if revenues and expenses start to getting a little tighter in the future because of Senate Bill 1, this becomes important. You know what I mean? Lining out your capital expenses and seeing where you can pay those from. CCNG and lane mileage. So you've been getting CCNG for a while, but now there's a lane mileage grant. But because the county has a wheel tax, you qualify for that already. But my understanding is the combined between CCNG and the lane mileage will not be above the 1 million that they approved, right?
So
Yeah.
with the Senate Bill 169 or 179, what has happened is that we will get a lane mile distribution. Remember that that's different than it's by lane rather than total mileage, which we receive our MBH from right now. So if we exceed the match of the total grant of the community crossing, so like let's say that it's $1 million to match. Well, if we exceed that in a lane mile distribution, we will no longer be qualified to apply for the community crossings matching grant. So now I do have some projections on what we're going to get. And like I said, I don't think we'll be able to apply from this point forward. They're saying that they are going to do a distribution in May, which means that we won't see it until maybe June or July, if it comes out this year, which they're still working out.
Is that CCNG or the lane mileage?
It's a lane mile
The lane
distribution.
Okay.
So for community crossings, we've already.
I may talk to you about that later too, about how they're calculating that. So,
We use the formula, LTAP has done it for most locals to
okay.
kind of figure out if they have it on their website.
Okay.
What are the lane miles because the cities want, because of all the multiple lane highways and where
Remember, if they don't have the wheel tax, they won't get that lane mile distribution. So
Yes.
if they don't have the wheel tax, they won't receive that.
So we've already seen quite a few municipalities do wheel tax last year. You're going to see more and more of that. And that's why they got rid of that double tax county and municipality. So, next page, continued capital. Not hugely important for you guys on page 15. It's just what I have projected in the Q Bridge Fund, which Steve gave me, and then commissioner and sheriff capital. So I'll get with you guys on any other capital that I may not have in the financial plan right now. Page 16. So I kind of mentioned this earlier with Kathy. Going back to future Senate Bill 1 impacts for property tax. So circuit breaker equals property tax revenue not collected due to properties hitting the tax caps. And then also you have the homestead credit of 10% up to $300. So what this graph shows is here's your 2025 circuit breaker. The blue was the circuit breaker in the general fund, and then the red was the total circuit breaker. You can see now these high level projections, okay? You can see how that circuit breaker increases up to 2030. It'll actually increase to 2031, but I wanted to keep the graph short, but 205 and 289 total in 2025, and then I've got 3 million in 2030. So that circuit breaker is shared amongst all your property tax levy funds. So it won't be just 3 million in the general fund. It'll be Cambridge, it'll be general, CCD, and things like that. So that just shows the impact of those deductions and homestead credits. And everybody's going to be facing this, not just Costco. Any questions? Okay. This is local income tax from Senate Bill 1. So I have 2026, 2027, 2028, and then I have 4 different projections for 2029. So this is the amount of local income tax revenue that you're receiving in 2026, projected 27 and 28, and then 2029. The first blue column is a 0.3% rate, the second 0.6, third 0.9, and fourth 1.2. So you can see how much more revenue is possible for the county. Now this is just the county rate only. This doesn't include the under 3,500 rate that we talked about earlier, where I said you would get 28% of that as well. So when it comes time to make these decisions, we'll have to look at what do we want the county rate to be? What do we need the municipal rate to be to make those units whole and also help the county? And then you also remember you'll have a fire and EMS rate and a non-municipal rate to adopt as well. And then on the right, the municipality rate, there's bullet points that show the dollar amounts on the different rates. That's not included in the graph. That makes sense to everybody. It's okay. Next page.
Okay, can I ask a
Yeah,
question?
yeah.
Okay, so this shows the income tax.
Mhm.
But it doesn't show how the property tax changes. In other words, it's not a combined, here's the change.
Right.
Okay.
Yeah. So, can you go back to page 16? You just look at 2030.
Yeah, okay.
You can say that total number, $3 million reduction. And then if you look at page 17, you can see how many dollars are collected by each rate. And then you can compare that to 26 through 28. So, you know, in 2029, if you did a 0.6% rate just on the county, you're looking at 6 million more just on that rate compared to what you're currently receiving. So that offsets more than what you're losing in property tax rate.
Thank you.
But yeah, I can put one together that combines it.
I think that's.
That would be good.
Okay.
Yeah.
Okay.
No, it's also this. Yeah. it would be-
So I'll work on it. As I mentioned, circuit breaker will continue to increase. The county can offset those losses with lit if they choose. But this may not be the case for the municipalities. Their budget's going to be a lot tighter. So they'll want to be made whole. You have to take them into consideration as well, determining the rates. As mentioned before, also the new lit is general purpose. So it's not earmarked to just one fund. You can place it where you like. It's the way it stays right now. That could change. And then obviously Reedy will continue monitoring legislation. There was already talk this year about counties having a lower cap than 1.2, so that may come up next year.
Isn't a part of the problem though, the people that live in the municipalities, there is truly no way to break out exactly what their income tax payments are going to be because they are not segregated in any way.
Yes.
This has been a long-going project. They came to the AIC 5 years ago and asked if we wouldn't give $500,000 to start that process. And here we are 5 years later, and now they think they can get it done in 2 years, which I believe is a part of the pushback.
I have a Seymour address, but I don't live in Seymour.
Yeah.
Yeah,
I have a Warsaw address.
And yeah, I mean, I work in Clarksville. They have Sellersburg addresses in Clarksville. How do you?
We are not unique. You nor us are unique. Every county has that same issue.
Yes.
So until they get the first year where they've actually pulled out and been able to separate cities, municipalities from the counties, nobody's going to know what anybody's getting.
Yeah.
In my humble opinion.
And that's probably another reason for the 1 year delay.
Yes.
And they may delay it next year to 2030.
And then they delay it another year and say, you know what, we had one bad, maybe we'll go back.
Yeah. So, yeah, I agree with you. I don't know how they're going to do that at this point. So, like, if the municipality does their own, how do you
Where's the line?
create that data, right?
Mhm.
Yeah, because you can't use addresses. So, cash reserves, obviously, county has healthy cash reserves, but keep an eye on the highway funds. Probably in the near, especially for the wheel tax fund, I think that's the cash reserves are getting really low on that. So you may have to move that somewhere else or just keep that in mind or when we look at budgets. So, Cume Bridge Fund, as I mentioned, any reduction in tax rate or increase moves it out of the general fund. So keep that in mind. If we're in 2029 or 2030 and circuit breaker's high and you have plenty of cash in your Cume Bridge Fund, you can reduce that amount again, still pay for your bridges, but put a little bit more money in your general fund. 911 fund, that keeps spinning now as well, as you know, that may have to be moved. You guys may have a plan for that already. But that's spinning down close to zero and it might have to be moved in the future to the general or somewhere else. And then obviously continue to be prudent in developing budgets because we just don't know what's going to happen right now. Will tax rates be capped? There's talk of capped tax rates, which is a whole nother discussion. I don't know how they would do that because a district's going to have to be capped, tax district rate, and that's challenging, I think. As I mentioned at the bottom right, the wage increase I have in the financial plan in this binder is 2% as of now. But as we get closer to budget, we can look at different options for wages. So this in April, the DLGF will release circuit breaker. That'll be very helpful because it's kind of we've estimated it, but we don't know 100% for sure what it's going to be. And then later on, we'll get assessed values, and then we'll be able to plug that in and see what your revenues are going to be, and then look at wage options. And then next steps, I would like to meet with you guys again for budget purposes. I think we met in August last year. But I can meet again in August, or I can meet earlier.
I think August is too late.
Yeah, I can meet earlier.
The department heads have to have their budgets completed and turned in to you guys by what, mid-June? Second week of June, somewhere along in there?
May, end of May.
And I know there's continual adjustments on the,
The budgets have to be developed and turned in so they can put everything together
Yep.
for us to do our budget hearings.
right, yeah. And I was thinking maybe July,
Yeah, their budget meetings with the departments are scheduled in August.
yeah.
So what do you think, Melissa? When would you like to come up with sort of thinking?
Before the budget meetings with the departments.
Towards the end of July.
End of July, keep it end of July. I think last year was beginning of August.
I think it would maybe be helpful if we had the information from the departments and then have a meeting.
Yes,
I agree with that.
yeah, I'd like to have that at
Yeah, and
least,
then you would have what,
at least.
because if not, you're just coming and talking in
Correct.
general. We're not
Yeah.
looking at specific
Yeah, and I know
lines.
June is the typical date to get those, but there's adjustments after that, so you think early July is best?
I would think so.
Okay. We do that.
So, yeah, if you want to shoot us a couple dates, then
Okay, I'll do that.
Okay, I'm staying out of that. I'm letting you guys work that out. So you know. I'm their liaison. But I'm like, you guys work that out. Just let me know.
Yeah, I'm sure more things will come up by then too, for budget
Yeah.
purposes, so.
Are we done? Or
That's all I have.
Can you go back to page 17?
Yeah.
And just explain the 35,000 foot view for me of how we're currently at 1% lit.
Yeah.
But then even with the rate in 2029,
Yeah.
if it went
Good
down,
question.
revenue still goes up.
So the reason you're currently at 1% and the county's only receiving 12.5 million in 26 is because that 1% is distributed to all the units. Whereas the 0.6 in the blue all goes to the county.
I see. So there's no sharing.
There is sharing, but
But not as
you're
much.
gonna have a rate just for the county, a rate for fire, a rate for non-municipal, and a rate. You will have another rate that's shared. That makes sense?
so in general, it's because we're sharing we have to share all this. They're certified
Yeah.
shares, so it gets split amongst I don't know how many tax credits.
And then, so that's just the county rate that I have in the blue. And then on that right side, is the municipal rate that's shared. And I have at each tax rate what I think the county would receive based on that rate. So you can take the 19 million and the 0.6% plus whatever rate you want to adopt on that dollar amount. There's so many scenarios, it's hard to create one graph for all the variations. We'll figure something out.
So on the tail end of the bills where you're supposed to either get 1% or $300 max,
Uh-huh. Yes,
where is that coming off at?
that's
Is
coming
that
off your
just coming
final
off of
bill.
your, I get that, but
Yeah.
it was never calculated any place in what we are expecting on the abstract. That was never done anywhere. So that says that's just a net loss. Whatever those are, all added up is what we're just not gonna get, but we don't know what that figure is yet.
I don't know. I know they'll have it on the tax bill, like coming off the end. On the abstract, I don't know. I don't know if they'll have it. I know,
Collectively,
right,
that's gonna have a big impact. If we think we're gonna get, X million and it winds up this takes off
Yeah,
I mean, it probably won't take off all that much. It's not $300 per
Yeah.
property, but still.
and even less than that
And
for,
it's not even per property. It will-
Yeah.
I mean,
So, I mean, I've looked at mine and mine 10% would be $72
Mhm.
for my property.
Yeah.
But when you had a whole bunch of $72 or you had a bunch of 300, so,
yeah,
I mean, pretty soon you're talking about real money. So,
right.
But I just-
Ballpark for that,
but I just didn't
just roughest
know.
numbers.
We actually, let me get with you after the meeting.
Yeah,
The
I just didn't-
DLGF actually has a estimated number. They released a sheet and I'll pull that up for the fact. Yeah. But I don't know if surely they'll have that number in the abstract. I would think, but I'll check on that. Because you have to know how much you're going to collect. Right?
But what you're gonna collect. Yeah, you're right. You're gonna have to do that. And
Yeah.
you also have to know what you're gonna distribute. That's the critical part
Yes. Yeah.
of dealing on the second part of the abstract. Okay, I'm sorry, that's just.
Oh, no, 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 that's
Question, but
okay.
I'm
Yeah.
not Sure, how many dollars that would be.
I'll pull it up here after we're finished.
Okay, Carrie gave me a list of questions. I'm
Okay.
sorry he couldn't be here.
That's all right.
So the first one, we have projects planned. Is there concern over using edit dollars to complete these projects debt-free? For example, they have the
Parking garage.
park garage. Is that,
And as of what I have in here now, no, there's no concern. Now, if there's been additional, I still don't think there'd be concern, but I have, let me look at my capital.
so in other words, you had one page that we didn't go over that had the
Yeah,
capital
so
stuff for
if you
the
go to,
edit funds for the county commissioners?
if you go to the capital improvement plan tab, it's on the very left.
Oh.
So the tab,
Here, gotcha. Down here. Gotcha.
there you go.
Thank you.
Yes, no problem.
Um,
So you see the commissioners department, oh yeah, I'm sorry. So you see the commissioners department at the top.
Yeah.
That's how many total dollars I have for commissioners capital built into the financial plan. And then if you go to the table below that, you can see, general fund, commissioners department. You can see the dollar amount by year.
Okay.
Edit department, I've got 7 million and 26 and 6.5 and 7
Okay,
built in. And does that make sense?
yeah, it does.
Okay, and then, so that's all I have for now. That's
Okay.
what I'm saying. Like, there's more than that, there could be.
So that does include the parking garage.
Yes. And then I don't want to confuse anybody, but you go to. let me find the
But
page.
what you have on there is the commissioners have a capital improvement plan, and that's. what
Yeah.
we've Given you.
And I'll ask you.
Yeah.
Correct, and I'll ask you again if there's been any updates or
It's
anything
through
additional.
27, because it's a 3-year plan,
Yeah,
so.
yeah.
Next year will be. Or amended, depending on what's going on.
And the other unknown is what it's gonna cost us to fix this building.
That's another
Yeah.
question.
Yeah,
Okay.
that's coming up.
Okay, and then in that regard, where do you ask about that? Pros and cons of using rainy day, okay, for the repairs. Do you see a pro or well, the repairs that they were talking about? Is there a benefit of using either the rainy day funds or edit funds for that? Do you see any?
I think let's get the numbers and then see where the rest of it
Okay.
is what is my opinion. So if you look at page 29 in the financial plan, it's behind the capital improvement fund tab. Okay, 29. That is the edit fund. And as you can tell, I have the capital, so between the two green lines is 2025, and then I have 2026 through 28 to the right.
Mhm.
And you can see the red That's the, how much the fund's gonna spend down in those 2 years because of the capital I have for the commissioners.
Okay,
But you can tell, if you look at the very last line at the bottom, you can see the cash, ending cash balance. So, no, that's a good use of edit funds, in my opinion.
okay,
And I would keep it in edit.
if we can afford it.
I mean, it just depends on what the dollar amounts are.
Okay. What else did he have?
And I wanted to show you that fund too, because I have all these funds in this binder that you can look at.
He has a question mark, but I think you answered this. No change in edit dollars till 2029 when lit must be established. That's what the question that Will basically has. And then projections for projections for receipts of edit funds 2026, 2027. That's, you already put that in
Yeah.
that one.
So see the green in that graph?
Yeah.
That's a projection. I'm just using 3% for it.
Okay,
It's not like really detailed projection or anything.
Right.
I'm just assuming 3%.
so in other words, even though like we have budgeted $4 million in the 2026 for the parking garage, because our edit funds, in other words, it's gonna still stay flat, what we have available because of the money we're bringing in, the revenue we're bringing.
You haven't changed the lit rate. So the amount of revenue, it grows typically every year, but it's gonna
Okay.
stay flat.
Okay.
Yeah.
Yes, about that. Just building repairs lines are 750 budgeted, and additional 750K in 2026. Maybe I should just show you.
You can email me
Yeah,
the question.
okay, maybe I'll just, I tried to figure out how to send this.
I typed it up because I can't.
Oh, okay. Oh, well, then I'll let Marcia be in charge of this.
Oh, no. Okay,
You
so
sent it to
county
me.
general fund, he wanted to know what would be considered a conservative balance for county general itself.
Reedy Financial recommends 50%,
So,
but you guys are above that. I mean,
So you get it right, Nick, take notes on this for me.
and the reason
Fran,
the reason we use 50% number is because property taxes are received June and December. Every 6 months.
and then the same with the edit fund.
Edit fund different counties use edit fund for different purposes. If you're using it for capital purposes, capital funds, we just try to balance the cash. And it depends. Sometimes we'll try to build cash if you have a bridge you need to pay for, right? And in 4 years, we'll try to build cash up to that point. But if you're using edit fund to pay operational expenses, then 50% cash balance.
And there are some operational expenses. in
Yeah.
there, so
Yeah, I know insurance in the past, paid in
that'll
there,
come and
but
go.
you have multiple options for insurance where you pay it from. So
Uh, I think most of these are just statements, like the Justice Building repairs. We have to do a roof here
Yeah.
pretty soon, so 750,000. We're looking at that fund that is in CCD, I believe.
So CCD is another one that,
Because we have this year, 2027, we have 750,000 in there. We are increasing it 250,000 year over year to cover expenses for the Justice Building courthouse repairs.
Yeah.
So we would use part of it possibly the end of this year in what is in there for 2027 to cover that expense. with the road.
yeah, CCD, let me check something real quick. CCD is one that continues to, you have $5 million in there, but it spends down every year. So that's a good use of that for now. If you want to use the CCD fund, you can. Now, if you were a county that had 200,000 in your CCD, I would recommend moving it to edit, right? It just kind of have to balance where you have cash reserves and where you can spend it. Yeah, I think that's okay.
So I think the way that conversation went, when that guy came, I remember Joni was the one that asked, what would we need a year to make improvements in that year?
Mhm.
So I don't think that it was ever intended that it would be done the way it's been being done, in all honesty. Because in the end, you're gonna wind up with, if you were given $250,000 in 1 year and said, fix whatever you can fix with that, whatever you didn't spend in that year might be able to be moved forward to the next year, and then you get another 250 plus what you didn't spend back there.
Mhm.
But I don't know that it was ever intended to double on itself and add 250 to it every year.
Every year.
The end was supposed to be, because it took us $2 million to fix out of ARPA money. And Joni asked the question, what would it cost every year if we kept up the maintenance? What would it cost? And that answer was $250,000 based on his
An
estimate.
additional 250 every year, so I would think, or 250.
$250,000 this year, $250,000
Okay.
next year,
Okay.
$250,000.
But what they wanted to see happen was to cover like the Justice Building, money that we use for the renovations for that. You know, they say you replace a carpet like that in a building like this every 6 years. So they wanted to be sure when we got to 6 years, that money was sitting there in the pot.
Yeah, so in other
That's
words,
how
you're
that's
building
See,
it,
I-
you're building it.
Yeah.
I like just, okay, let's do a capital plan. Let's just do every 6 years. It's going to cost this much. And then that year we budget it. You know what I mean? Instead of carrying over appropriations. I think interesting.
With
But-
people at that point in time, I don't know that that was the appetite because
Yeah.
nobody liked that we had to have that big of a chunk of money all at once.
Mhm.
So that's
I
why,
see.
and personally, just tell me what you want to do.
And now you're doing those maintenance things on a more regular basis. I mean,
yeah.
You're doing great keeping stuff fixed and addressed, and I think that may work itself out.
Well, if they active approach rather than reactive,
Yeah.
if
Mhm.
it's happening, then you're bound to do better.
Don't fix the roof when it's leaking, fix it.
But it's not.
What line was that in the CCD fund?
It was 4.
Same, we see them.
Yeah, I got
The
it.
question
Sorry,
about the
you know.
tax loss from the credits, I found that on the gateway,
Yes.
and it's like 6.9 million.
So that's not terrible, $7 million in the big scheme of things. It's a lot of money.
Thanks,
but-
Steve.
Yeah.
Any problems?
Good day.
See ya.
Thank you. Good
Was
job.
that the estimate, tax cap estimation sheet?
It's the total tax credit detail.
Oh, okay. Okay.
44042 in edit, which is 1138. I mean, sorry, CCD.
CCD.
Yeah.
Okay.
Maybe I should. Oh, did you answer that? Am I interrupting?
Well, I'm gonna ask for a capital request, and then you
Okay,
guys can fill that out.
I think
I'll
that's
just go
what
through
some
a
of
list.
these things are.
Yeah, because that's
Yeah.
pretty much what those 1 through 4 were.
Yeah.
Percent applicable.
Right, thank you.
Yeah, no problem.
Thanks, Tyler.
No problem.
Thank you.
Thank you so much.
Yeah.
Very interesting.
Yeah.
Good job.
Thanks.
Oh,
Hopefully they didn't
Kim
tow my
wanted
car.
to tell, Kim texted me and said, but all know in the meeting, I reviewed what was sent and I will also watch the meeting.
I'm gonna pull up the DLGF's estimated tax cap. Says,
Yeah, because I just looked at the credit detail.
Oh, you guys in your coffee.
Oh,
I do tea in the morning.
That's not
I
very
don't
fun,
think this
right?
is just recording. I didn't even-
Green tea, hot green tea?
Yeah.
I do too.
Because I used to do
There you go,
coffee
just
and the coffee
take one out of there.
cravings give me like,
Give me that mix.
Yes.
quit drinking that coffee. Yeah, I don't do fruit coffee, just like, tar.
Very first call.
Thank you, Tyler.
Yeah, no problem.
Thank
Yeah,
I have a couple questions for you. I'll
Yeah.
email you for redevelopment purposes.
Okay.
Because I serve on that. I know they're gonna have some questions coming up.
Right.
So
Okay.
Have a good day.
Hey, Dave.
That's fine.
just get your recommendation.
Okay.
Similar.